Hi, welcome back. I decided to take a break from the data updates I've been doing. I've done 5 and I have a couple more left to talk about the 7 stocks that saved the market in 2023. Sounds like I'm over the top, but you know what the 7 stocks are, right? It's Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla. And they basically carried the market in 2023. Now, a couple of days ago, I was on CNBC and I heard somebody refer to these 7 companies as the Magnificent Seven or the Mag 7. And I'm going to stick with that because that's what other people call them. But left to my own druthers, if I'd been asked to name them, I'd have called them the 7 Samurai. For those of you who've seen the movie, this is a legendary movie by the Japanese director Akira Kurosawa. And it's about these 7 samurai who save a village and villages from bandits. Now, you can argue that these 7 companies saved investors from the marauders, inflation, and the economy that were coming at them in 2023. But enough of the lead-in. Let's talk about the 7 companies. Now, it's worth remembering that before you had the Mag 7, you had Fangam, and then you had Fang. Fang, of course, was Facebook, Amazon, Netflix, and Google. Middle of the last decade. Then we added Apple and Microsoft. It became Fangam by the end of the decade. And now we've dropped Netflix and added, 2 companies, Tesla and Nvidia. And why do we do it? Because in a sense, we're adding on the most successful companies. And you can see already there's a hindsight bias here. That if you keep dropping bad companies, adding great companies, you can always create a group that looks like it's supernatural in terms of the returns it delivers. That bias notwithstanding, let's face it, these 7 companies are at the center of the market. They're the 7 largest market cap companies. And it's still worth looking at what they did last year and perhaps why they did what they did. So let's look at what these 7 companies did in 2023. What I've done in this table is actually looked at the market cap for each of these companies at the end of 2022, the market cap at the end of 2023, and looked at the change in market cap in dollar value. You take Apple, market cap increased by $927 billion just in 2023. That's a 45% increase. Looking across the companies, in terms of dollar increase, Microsoft did the best year with $1 trillion increase in market cap. But Nvidia and Meta were the best performers in terms of percentage returns. Nvidia was up 240%. Collectively, these 7 companies added $5.1 trillion in market cap just in 2023. Just to give you some perspective, there were 6,658 publicly traded stocks in the US in 2023. Collectively, they added $9.3 trillion in market cap. These 7 companies alone explained $5.1 trillion of that $9.3 trillion. In fact, this was the end of the year. In the middle of the year, it was even worse. These 7 companies accounted for all of the increase in market cap of US stocks. Clearly, they carried the market. Now, this wasn't just 2023. If you look back in the 10 years prior, and that's what I've tried to do in this graph, and trace how the market cap of these 7 companies cumulatively changed over that period relative to the rest of US equities, here's what you get. You start off in 2012 with these companies at about 8% of the overall market. By the end of 2023, these companies were at 25% of the market. Their market cap had gone from, if you think in terms of value, less than $1 trillion to more than $12 trillion. Now that 12 trillion is worth thinking about because collectively these 7 companies are worth 12 trillion. And again, to provide some perspective, the second largest equity market in the world after the US is China. And after a drawdown in Chinese equities over the last 30 years, the collective market cap of Chinese equities is 11.8 trillion. These 7 companies put together have a greater market cap than all of the listed equities in the Chinese market. You can compare them to the other regional markets, it isn't even close. You could put Latin America, Africa, and much of Asia together and not get close to the market cap of these 7 companies. Now, when you've had 7 companies do so well, clearly they account for a big chunk of the returns you see on US stocks. Just to give you a sense of how much these 7 companies have contributed to the returns you'd have made investing in US stocks, here's what I did. I went back to the end of 2012 and I invested $100 in US equities. Then I tracked the increase in value through the end of 2023. Not counting dividends, $100 invested in 2012 would have amounted to $343 by the end of 2023. Not bad, right? An increase of 243%. That's with all US equities held in proportion to their market cap. roughly what you'd have get in an index fund if you bought an index fund, the S&P 500 index fund. The second thing I did was I take the same $100, I invest in all US equities except the Mag 7. All I did was take 7 stocks out of 6,660 stocks. Take a look at what that $100 is worth at the end of 2023. Removing the 7 companies reduces my end value from 343 to 282. I've dropped 62 billion, in this case $62 of my value. About 20% of my overall cumulative value is gone because I did not have these 7 companies. You might say, who cares? I think this graph is particularly useful in thinking about active investing, its costs and benefits. Think about why we do active investing. We do active investing because we think we can pick winners. And it's exactly the behavior of the stocks like these Mag 7 that makes active investing so attractive. If only you can latch on to these 7 companies in your portfolio and not hold the rest of the laggards in the portfolio. Think of how well you could do. That's the attraction. But these 7 companies also illustrate the danger of active investing, because you go pick stocks and your stock picking leads you to pick everything but these 7 for whatever reason. You've dug yourself a hole from which you can't extract yourself. And much as you'd like to beat up on indexing, let's face it, with indexing, you will never have that problem. So, now, some of you might very well be aware, and you might actually be people who believe in the value premium and the small cap premium. Small cap premium is a premium that goes back a century and claims that small cap stocks earn a higher return than large cap stocks. And through much of the 20th century, that turned out to be true. The small cap premium has pretty much disappeared and in fact turned negative over the last 12 years. You're saying, why? Well, none of these 7 companies would ever have qualified as small stocks. If you had a small stock portfolio and that's all you held, you're already at a deficit. It's tough to get over the fact that you don't own these 7 big winners. Same problem with old-time value investors. They bought low price to book stocks and boring companies with assets in place. Nothing wrong, great philosophy. But in the last 10 years, it's crashed and burned precisely because it would have never led you to buy any of these companies in your portfolio. So factor that in. I'm not trying to talk you out of small cap investing or value investing, but I'm saying in a market where a few companies account for a big part of the returns, you have to think about the risks of not having those in your portfolio. Now, as you listen to people talking about these 7 companies, of course, they make it sound like this has never happened before. That is a very top-heavy market. This is unusual. That's actually not true. What you saw in the last decade is more the norm than the exception. In fact, Hendrik Bessembein, who teaches the University of Arizona, did a very interesting study where it looked at all U.S. stocks that were listed between 1926 and 2019. And of the 47 trillion in increase in market cap over that period, he found that 5 companies accounted for 22% of that increase. That looks very much like what we found with the Mag 7. In fact, he found that almost 55% of US stocks earned less than the T-bill rate over that period. It's the big winners that make for portfolio returns. So, and I don't expect it to stop. In fact, 10 years from now, we'll be talking about the next group of big winners. They will have done exactly what the Mag 7 did over the last decade, explain half of the increase in value of all stocks. Now, my only prediction is that when you look at that list 10 years from now, you're not going to find any or all of the companies in the Mag 7, because the Mag 7 start at a disadvantage. They're already big companies, and it's tough to keep growing in high percentages when you're that large. So that's a what. So let's talk about the why. Why did these stocks soar? Whenever you have companies go up as much as these 7 companies have, you get one of 2 responses. One is regret. You say, I wish I'd bought those companies. It's not going to do much for you, but it's human nature. The other is when you see stocks go up this much, there is this feeling you get they must be overvalued. It's actually very widely held that if stocks that have gone up a lot must be overvalued. And it gives rise to what I call knee-jerk contrarianism. What is that? You take the stocks that went up the most over the last year, the last 5 years, and you sell them if you have them, or you sell short if you don't have them. It's a strategy that would not have worked with this group of stocks because they would have looked consistently overpriced if all you did was look at past performance. So it's a dangerous strategy, but those are the natural responses. Now, so I think it makes sense to take a look at why these 7 companies did as well as they did. And I can think of 3 possible answers. One is that it was a correction. I mean, these Mag 7 increased in value by 5.2 trillion in 2023. Did I remember to tell you that they actually dropped 4.5 trillion in market cap in 2022? So some of this is to come back from a really bad year. That what you're observing is a comeback story, driven by momentum and the reversal of momentum. And fair enough, there is some evidence that there is a correction story that explains 2023. And to answer, to see if that story holds, here's what I did. I took all listed US stocks. I looked at what they did in 2022 and classified them into deciles from worst performing to best performing. Bottom decile includes the worst performing stocks in 2022. The top decile is the best performing stocks. And I looked at what they did in 2023. And you can pass judgment for yourself. But here's what you see. The worst performing stocks in 2022 are the best performing stocks in 2023. They were up 35%. The best performing stocks in 2022 were the worst performing stocks in 2023. They were flat in a year the market was up. You're saying, good, then it's all correction. Well, not so fast. Here's what I did. I took the worst performing stocks, and all of the Mag 7 stocks were in that group. And I separated the Mag 7 from the rest of the worst performing stocks, about 620 stocks. And then I looked at the comeback in each group. The worst performing stocks, not including the Mag 7, were up 19%. Decent comeback, but the Mag 7 were up 74%. So there's a correction story, but it can't be the only thing that explains what happened in 2023. The second try I took was to say maybe they're great businesses, and that's why you saw what they did. And I think there's evidence that in 2023, the surprises that these companies delivered were on the business end of sense. First, if you remember coming into 2023, there were 2 big macro worries that investors had. One was that inflation would hang in there and make things difficult for companies. The other was that we might go into recession. And let's face it, the big tech companies in particular have never been tested with inflation and through a recession. The question was, will they have enough pricing power to get through inflation? Will they have enough economic resilience to live through a recession? I think they delivered on both counts. They showed they had pricing power, and I'll show you some evidence of the pricing power. And they were able to have resilient earnings and growth in the face of a weakening economy. In fact, these companies turned out to be money machines. They have always been money machines. They continue to be money machines. And Alphabet and Meta in particular laid off thousands of employees. You're saying that's bad news, without putting a dent in revenues. And we'll talk about what that tells us about those companies. And finally, if safety was what you were looking for, and one of the things you were worried about was the debt overhang. Because let's face it, companies that had borrowed money in 2018, 2019, 2020, old debt, had borrowed those money at low rates, you wondered how they would fare when they went back to markets where rates are much higher. We didn't have to worry about that with these 7 companies because they had so little debt and so much cash that this issue went off the table. So there's business reasons why these companies look good. And let's start with pricing power. I'm going to start with the 2 companies with which I have almost daily interactions. One is Netflix and the other is Amazon. I own Amazon Prime and I'm a Netflix subscriber. Now, I'll wager that many of you are Netflix subscribers and Amazon Prime members. And if you check out what your credit card has been charging you, your Netflix subscription is a lot more expensive than it used to be. It's gone up, and especially in the last 5 years, you've seen the price almost double. I mean, I'm right now paying close to $23 for a family subscription on Netflix. Similarly, Amazon Prime prices have gone up from $79 to $99 to $119 to $139, and Amazon is taking away some of the benefits. In fact, I recently learned from Amazon that if I wanted to continue to watch Amazon Prime Media without ads, I would have to pay $3 a month. In effect, they're raising prices and there isn't a rush for the exits, right? I haven't heard of too many people canceling their Netflix subscriptions or their Prime memberships. Clearly, they're showing pricing power. The other companies, it's a little more difficult to get to it, but I was just reading that the cost per click on Google for ads has went up substantially in 2023. And about 73% of the businesses that advertise on Google saw higher costs. Yeah. Now, of course, Tesla was the exception here, where they lowered prices, but it was less an indication of pricing power and more, I think, a tactical move, and will perhaps to make themselves a mass market company. But outside of Tesla, every one of the other 7 companies clearly showed the capacity to raise prices and deliver profits. In this table, I've looked at 3 measures of profits: gross profits, operating profits, and net profits, and converted them into margins, gross, operating, and net margins, for each of the 7 companies. If you look across the companies, you can see they almost all have healthy margins, with the exception of Tesla. Tesla's gross margins are much lower, not because it's a bad company, but because it's the only manufacturing company in the mix. You're saying, what about NVIDIA? NVIDIA actually doesn't make chips. It designs the chips. Taiwan Semiconductor makes the chips for them. So what you're seeing here is an intermediary or a design company, not a manufacturing company. Tesla's gross margins are low because it has to make cars. Cars are expensive. The unit economics work against them. The same things play out in operating margins. You'll notice that as you go from gross to operating margins, Amazon has a big drop off, lots of expenses between the gross income and the operating income. And in fact, they end up with a net margin of 5.29%, which is the lowest of the 7 companies. But that's not bad for retail. In fact, the median margin for operating margin for retail is little less than 5.5%. Amazon has a higher margin than the median retailer now. But here's what makes it even more impressive. These margins and profits, I think, are understated because these companies are all big spenders on R&D. I've listed out the R&D expenses, and collectively these 7 companies spent $235 billion in R&D. You're saying, so what? Accountants expense R&D, it lowers earnings, but it's really a capital expense. So I capitalize R&D, and when I capitalize R&D, I get what I think is a much better estimate of what the profitability of these companies. My R&D adjusted operating margin is much higher. So compared to the operating margin which I had before, and you can see that for Amazon in particular, the margin almost doubles when I capitalize R&D. That, I think, is a much better measure of how profitable these companies are. And let's face it, they're immensely profitable companies. Collectively, these 7 companies accounted for about 11% of the revenues of the S&P 500, but they accounted for 27% of the gross profits. So they account for a disproportionate share of profits because they're much more profitable than the typical company. Finally, on the safety issue, as I said, these companies have very little debt. There are only 2 of the 7 companies have debt that is higher than cash. In fact, one of the measures of how much debt load a company carries is the net debt, the difference between debt and cash. 5 of the 7 companies in my mix have negative net debt. In other words, cash exceeds debt. There are 2 companies where cash is less than debt, Amazon and Microsoft. But even for those companies, if you scale it to the market cap of these companies, the debt load is minuscule, 4% for Amazon and less than 1% for Microsoft. So I think we can make a case that these companies have business models that have shown pricing power and economic resilience, that they're immensely profitable, some cash machines, and that they're safe companies in terms of how they're run. Incidentally, what you saw with Meta and with Google in particular last year was thousands of people being laid off. Now, by itself, that's usually bad news, but in the case of Google and Meta, their revenues remained intact. What does that tell you? These companies, I think, built up incredible buffers during the last decade. Now, I remember going to Google's campus in Northern California a long time ago, 2018. Amazing campus, all kinds of add-ons that you get. And I watched dozens of people wandering around looking like they had nothing to do. And I said, no, maybe I don't quite understand. Maybe they are thinking and doing great things. Or maybe they have nothing to do, because what the layoffs seem to suggest is that at least a subset of the people at these companies did not add anything to the top line, no effect on revenues. And laying them off had therefore no effect on revenues. It's a nice buffer to have as a company, and these companies have it. There's a third potential explanation, and this is a much bigger picture explanation for why these companies have done what they did. I think the 20th century, if you looked at businesses, there were a few businesses which moved towards monopolies, but they became regulated monopolies, power companies, phone companies. The 21st century, increasingly in business after business, here's what we're seeing. Businesses that used to be splintered have increasingly become winner-take-all or winner-take-most businesses because of the disruption. Let's take an example. Advertising. Advertising 25, 30 years ago, even 20 years ago, was a splintered business. Even the largest players, the New York Times or the broadcasting companies, none had a market share of the total advertising market that was in the double digits. And then along came Google and Facebook with online advertising. If you look at the last decade, and online advertising is the bulk of advertising now. 60 to 70% of the growth in online advertising has gone to the biggest players. Why? Because in online advertising, you want to advertise in the places where everybody else hangs out. In other words, there's a networking benefit. The biggest players become even bigger and more attractive. And that's what you say. Over the last 2 decades, Amazon has upended the retail business, the ultimate splintered business, and replaced it not with a monopoly, a dominance in retailing we've never seen before. Microsoft, of course, has had a stranglehold on both application and business software for 3 decades. Winner-take-all businesses. In fact, there's 2 newcomers into the group, NVIDIA and Tesla, were the biggest questions because neither the chip business nor the automobile business historically has been a winner-take-all business. Remember, in 2008, before Tesla came along, the biggest automobile companies, Volkswagen and Tesla, had market shares of 10% or less. It was geographically splintered by which consumers you went after. Will that stay when these businesses shift from traditional gas autos to electric cars? We don't know. In fact, the same thing with the chip business. The AI chip component going to change the economics of this business? The real answer is we don't know, but there is a plausible path you can see that these businesses also are going to become winner-take-all businesses. And I think investors are pricing in that possibility with both NVIDIA and Tesla. So at this point, if you ask me to describe these companies, clearly they're companies that have extraordinary business models, deliver huge amounts of profits, and are safe. They're really good companies. You think that must mean they're really good investments, right? Here I beg to disagree, and this is a point I've made before. You can have a great company which is a bad investment. And here's why. Now, the way to think about an investment is not how good a company is, but how good a company is relative to what people expect it to be. Now, let's say you take a company and based on your assessment of its business model, its profits, its debt, you can rank it from awesome to abysmal, from really good to really bad. That's your assessment of the company. Remember, other investors are making this assessment as well. Investing is about a mismatch. If you think a company is awesome and so does everybody else, you get a match. You get a great company that's priced accordingly. You think a company is abysmal and everybody agrees with you, the company will be priced like crap and you'll get exactly what you expected. What you're looking for is, if you're looking for a buy, is a company where your assessment of the company is better than the market or other investors' assessment. So if everybody thinks a company is very bad, but you think it's just only average, that's a good investment. Conversely, if you think a company is awesome and it's only very good or good, that's a bad investment. You should sell. In fact, investments that fall where your assessments and the market assessments match up, you can think of fair value investments. So you see all the red boxes, those are your sells and the green boxes are your buys. And it's based on whether your assessment is higher than the investor assessment or lower. So the question with the Mag 7 is, what kind of companies are these? I think I provided enough ammunition to decide that they're very good, maybe even awesome companies. The only way to assess whether they're good investments then is to dig deeper. Now, I know many of you don't buy into intrinsic valuation. You think it's a lot of navel gazing and Excel spreadsheets. I don't disagree with you. Make a lot of assumptions. But to me, intrinsic valuation is a way of thinking through what you believe about a company and where it shows up in the numbers. So here's what I decided to do. I took the 7 companies and I decided to do an intrinsic valuation of each of them. I've just given you the summaries here, but at the end of this session, I will put up links to the Excel spreadsheets with the full valuations. You can go in and change the numbers to your heart's delight. These are my stories, my valuation of the company. And I'll start with the bad news. All 7 of the Mag 7 companies look overvalued. That's the bad news. But if you look at the percentage difference, it looks like Tesla and Meta are not really overvalued. They're close to fairly valued. Alphabet, Amazon, and Apple are within shouting distance of the value. There are two companies that look overvalued. One is Microsoft at about 14% and Nvidia at 56%. Of course, what do they share in common? They're the two companies that have got the most reflected glory from AI. Now, don't get me wrong. I think both these companies will benefit from AI. In fact, when I valued Nvidia, a huge chunk of that value you see, $436, comes from my assessments of the AI market and how Nvidia is going to continue to lead that market. When I valued Microsoft, the reason I give them a 15% growth is because of the second win they're getting. They're a mature company. And in fact, if you look at the growth rates I'm giving for these companies, for four of these companies, Alphabet, Amazon, Apple, and Meta, middle age is approaching. You can see the growth rates are either single digits or approaching single digits. Doesn't make them bad companies because those single digit growth rates come with immense operating margins and lots of cash flows. But at least based on an intrinsic valuation, you can see my judgments. I'll talk about what I'm going to do with these judgments. Incidentally, if you don't like doing an intrinsic value per share because that requires a cost of capital, I've computed an internal rate of return. What I've done is basically taken the current price, taken my expected cash flows, and backed out what internal rate of return you'd earn based on the cash flows. And if you look at their numbers, they range from the highest 9.16% for Tesla, the lowest 7.18% for Nvidia. You're saying, what do I do with that? To give you perspective, I can give you what the numbers look like for a typical US company. At the start of 2024, across all US companies, the median cost of capital is about 8.6%. Tesla is the only company that earns more than the median. So if your median becomes your proxy, 6 of the companies look like you don't earn as much as the median company. But remember, these 6 companies are much better than your median company. I can see why you might be willing to stretch and accept, Apple at a 7.89% return, lower than the median, but much bigger, much safer, and much more robust than the typical company. So take what you want out of that. But as I said, the entire Excel spreadsheets are there. You can go in and change the numbers if you don't like my assumptions. So the bottom line here is that other than Microsoft and Nvidia, which look overvalued, and I think the overvaluation comes from the AI buzz and people overestimating how much it can help these companies. Companies look surprisingly close to their fair value. Why surprisingly? Because when I sat down to value these companies, I thought I would find all of them to be overvalued by much more than I did. Now, most of the time when I value a company, it reinforces my priors. But once in a while, intrinsic valuation can surprise you. And I was surprised at how close to the price I was able to get with the value. Of course, what's the point of valuing companies if you can't act on them? So I'll start with a confession. I own all 7 of these companies. And you're saying, what? They're all overvalued. Why would you buy them? I didn't buy them yesterday. In fact, other than Tesla, which I bought a couple of weeks ago at a close to $180 per share, the other 6 companies I bought at different points in time. Microsoft in 2014, Apple in 2017, Nvidia in 2018. And at that time when I valued the companies, they looked undervalued. Okay? Now the question is, am I selling now that they're overvalued? Not so fast, because as you saw, 4 of the companies are within single-digit levels of the value. Remember, there's a margin of safety when you buy. Why shouldn't there be a margin of safety when you sell? There's an added cost, though, when you sell a big winner, which is you got to pay capital gains taxes, which for me at least is around 30%, with state taxes added on. So stock has to get overvalued by about 30%, and I think the only stock that meets that threshold is Nvidia. If you remember, I valued Nvidia last summer. I found it overvalued then, and I ran into the same conundrum that I'm running into now. And I said, I'm selling half of my Nvidia holdings, which struck some people as inconsistent. And I said, look, I'm selling half because I don't want to live my life with regrets. And here's why selling half works for me. If I sell half and the stock goes up, I can say, look, I held on to half, and the stock goes down. I said, look, I sold half. I know this sounds like I'm eating my cake and having it too, but spare me my little indulgences. And I have the same reaction now. Stock's at 680. Part of me says sell everything you've got left, but I don't think I want to. I think I'll sell another half of the holdings and hold on to the remaining half for precisely the same reason that I did during the summer of 2023. Now, In closing, though, as you look at these 7 companies, recognize that this is not unusual, that much of the winnings in the market come from a few companies. There's good reasons why these companies were targeted. They're well-run companies, they're special companies. They're business models that deliver growth, even though they're big companies, and profitability. And if you never own these companies, your portfolios will reflect that choice, that your returns over the last 5-10 years, but jumping onto the bandwagon now can't make up for that failure. You're not going to get your money back. But don't give up yet, right? Right now, they might be overvalued. But remember, these companies are priced with great expectations. And when you have great expectations, you tend to disappoint. And you disappoint, the price will drop. And if you bide your time, they will be cheap again. Nothing stays overvalued forever. Nothing stays undervalued forever. Just wait till the price is right. I hope you found this session useful, and thank you very much for listening.